So the question shouldn't be, will rates drop? The question should be, how can I protect myself from being inflated into poverty? Last week, I mentioned that mortgage rates are tied to the bond market, and that's not something most people know. But trust me, it's one of the most important connections you need to understand if you're serious about building wealth and achieving long-term financial freedom. Give me 10 minutes and I'll break down in plain English, simple and clear info that could help you think smarter about interest rates and home ownership. Hi, I'm Peter with The Clear Close, the mortgage experts that get you clear to close on your next mortgage. To understand the relationship between mortgage rates and bond yields, we have to understand a couple things. Number one, bond and bond yields, and number two, mortgage-backed securities. But before that, consider subscribing to the channel, giving a like, maybe leaving a comment. These actions cost you nothing and they support the channel more than you can imagine. Thank you, and back to the video. Let's start simple. What's a bond? It's basically lending money to the US government. There are three ways the US government borrows money. The first is T-bills. It's a 1 year or less term. The second is a T-note or Treasury note. It's a 2 to 10 year term. And the third is a Treasury bond or a T-bond, or sometimes we just call it a bond. This is a 20 or 30 year term. And we'll be focusing on the bonds, the T-bonds, because they most directly impact the 30-year mortgage rate. A US T-bond is generally considered the safest investment. Basically, it's risk-free. Corporations sell bonds all the time in order to borrow money too. But corporations could go bankrupt and those bonds become worthless. In other words, you don't get your money back. However, the US government has the unique ability to always pay their dues. Why? Because they have two powers, the power to raise tax and the power to print money. Put a pin on that. We'll come back to it later. Now let's talk about bond price and yields. Here's a key concept. Bond prices and yields move in opposite directions. Like I said, buying treasury bonds is basically loaning money to the government. And investors love treasury bonds because of its risk-free nature. It's like free money. If there's a natural demand for US treasury bonds, the price of the bond can go up. The face value of that bond can go up. Conversely, the yield goes down. And the yield is basically kind of like an interest rate that gets paid for holding on to that bond. Just like when you pull out a mortgage, you pay the lender the principal plus interest. Well, just replace that word interest with yield. However, when natural demand for these bonds go down, the yield has to go up in order to incentivize buyers to buy the bonds. The reason why the government is selling these bonds or auctioning these bonds is because they need to raise money. They're trying to borrow money. Think of it in supply and demand terms. If supply is going to be the same, but if demand goes up, price goes up. If demand goes down, price moves down as well. It's not just the mortgage rates that get affected by bond markets. It's every type of lending gets affected by the bond market, from business loans to car loans to HELOCs. And by the way, if you're looking for a HELOC, you can use the link in our description. Think about a bank like JP Morgan Chase or Bank of America. If they decide between giving you a business loan or buying a treasury bond, what do you think they're going to pick? Usually, they're going to tend to go with the safer bet unless they can get way more return for their money from a commercial loan for your Labubu reselling business. And if you think business loans are based off of Wall Street Prime or SOFR or LIBOR, you'd probably be correct, but where do they get their rates from? Let's take a quick look at this chart that tracks the Fed rate versus the Treasury yields. See a pattern? Now, let's move on to mortgage-backed securities. Mortgage-backed securities, or MBSs, are essentially bundles of home loans that get packaged together and sold off to investors. No, not all MBSs are bad like in The Big Short. When done right, they're a stable income stream for investors, backed by loans from borrowers with good credit, and mortgage loans in America rarely ever default. So MBSs are considered very safe bets. But who buys these MBSs? It's the same type of investor who's buying treasury bonds, looking for somewhere to park their money for a relatively risk-free rate of return. So when treasury yields go up, Fannie Mae, Freddie Mac, Ginnie Mae, these government-sponsored entities, they're the ones who sell the mortgage-backed securities to the investors. Think about it like this. If the United States government is like McDonald's and treasury bonds are Big Macs, Fannie and Freddie are Burger King and Wendy's. When the Big Mac goes on sale, you're going to see the Whoppers and the Junior Bacon Cheeseburgers go on sale too. They move together. They're correlated. So that's a quick overview of how and why your mortgage rates are linked to the bond market. It boils down to supply, demand, and risk. Who has the cash, who needs the cash, and the incentive structures to get that cash. All right, let's bring it home. If you're shopping for a home and you're still waiting for interest rates to drop, here are some things that need to happen to cause bond yields to drop. Number one is recession. In a recession, capital flocks to safety, and historically, the safest asset in the world is the United States Treasury bond. The second is disinflation, not deflation. When the interest rates come back down from a high rate to a more normal rate like 2%, it signals to the market that stability has returned to the economy, which could increase confidence, thereby increasing demand. And like I said, if demand rises, then price rises as well. But you have to remember, this is all things considered equal. The third is global instability. When the rest of the world's economies are shaking, investors in those countries will look towards the United States for stability, for a safe return. And when foreign investors flock to the United States Treasury bond, prices go up because there's a set supply, and that will in turn cause yields to drop because the United States doesn't need to give as much incentive to sell those bonds. The last is by far the most likely scenario given our current economic situation. What we're going to need to see is the Federal Reserve buying bonds, aka quantitative easing. The US is not in a position to garner the confidence of the rest of the world. That's being reflected in the failed bond auctions, the bond sell-offs that we've been seeing in the news lately. And our interest payments are essentially 20% of the total tax income. This isn't sustainable. So, in my opinion, in order for mortgage rates to come down anytime soon, it would have to be an action by the Fed to buy bonds, which leads to inflation. And here is the problem. We're going to get a repeat of the last 2 years with prices skyrocketing. And you feel like you've been priced out of a home now, just wait till the Fed starts buying bonds. So what would I do knowing all of this? Remember, I'm not a financial advisor, I'm not a CPA, and this is not financial advice. I'm just a guy on YouTube that likes to read. So the question shouldn't be, will rates drop? The question should be, how can I protect myself from being inflated into poverty? Personally, I'm putting as much of my money into assets that can't be printed, whether that's real estate, gold or silver or Bitcoin, productive businesses, whether that's in the form of stocks or whether that's actually purchasing a business, because you have to remember, the United States economy is built to reward ownership. That's how you stay ahead of inflation, and that's how you build generational wealth. All right, if you've got this far into the video, thank you so much for rocking with the Clear Close. We're working hard to bring you unique insights and perspectives in the real estate and mortgage space. If you want help deciding what makes sense for you and your situation in regards to investing in real estate or pulling out equity from your home in order to invest, use the link in the description to schedule a one-on-one consultation with us. It's free, no pressure, just clarity. And remember, the Clear Close is here to get you clear to close on your next mortgage. All right, thanks for watching. We'll see you guys on the next one. Bye.